Welcome to Belkiot.com's analysis of the CME S&P 500. Today we're looking at a daily view of the S&P 500 bars using the El Mustafa Belkiot's tool, La Rivière de Belkiot, or the Belkiot River. This indicator is now applied. It actually has many different variables, but the ones we're going to use for the daily chart involve looking at horizontal as well as vertical support and resistance lines, as well as diagonal channels. We call these outside envelopes, and inside the solid trend lines are actually dynamically built lines that show or reflect the direction of the price itself. A blue meaning it will be a long, and a red meaning a short would be in place. To continue further, you can see the outside channels now defined, the blue being an upward movement, and the red defining what is in place of a downward movement. This particular line has been in place for approximately early January, in which case it has bounced off the line several times. We can see that we're in a short position at this current time. The trade channel shows a strong short where price is much further away from it. As price would rise, it would touch against this, but obviously it's riding on the inside envelope. And we look at the S&P 200-day moving average. Price is close or coming much closer to it. Right now, this number is at 1698, where the price is at 1742. It's conceivable that it could be hit in as little as a day, but probably could take up to a week if it's touched at all in order to cross over. Some other items of interest is that we went through a flat top area where the price range of the S&P 500 from December 26, 2013 to the 23rd of January of this year was only in a 2-point range. This is not actually a double top. I would hope that a double top would have a little bit more space between it and make it more powerful. But this is a very strong indication that the price of the S&P 500 reached some sort of plateau for whatever reason. The fact that there is no other price close to this historically is very challenging to try to gauge, but the fact it went sideways for a period of time does mean that no one was willing to go past that point. When it finally failed, you'll notice that the lops, which are the lower support or lower points, it hit the first lower support and then bounced off the second one, this purple line right here. To continue with the horizontal lines, we call them support resistance or hip lop aging. Hip lop means to us a high point or a low point. So the hip is a high point and lop's a low point. As we gauge these hips and lops, you'll notice that they actually have an age to them, how many bars old they are, and of course it shows the price. It is our opinion that this first price hesitated ever so slightly in reaching this first resistance point, a support point. Of note is price appeared to stop short of the 1738 mark. We believe that this is actually going to be a historical mark itself, where if price goes below this, it could start a strong downward movement. So where do we see the S&P 500 moving? We're going to start with resistance because we believe that is the least likely place that price will go at the moment. Our first level is a mark of 1813, denoted by the lower bar right here. We believe that price could come up there and show some kind of resistance. The next mark would actually be the would be the value of 1843.6. Obviously, this is the one where price cannot travel past for a month. This is going to show an extreme amount of resistance, in our opinion, so it should bounce off of it several times before crossing over. On the support side, we actually believe that's where price will travel. At this point, the first note would be the 1738 mark, denoted by this bar, this purple line right here. The 1738 should be noted as being a line in the sand, where if the price actually crosses below that, the next nearest mark would be the 200-day moving average, which is at 1698, and of course down to the 1642 being our third level. We're concerned that if price actually crosses over the 200-day moving average, that this could be significant for a lot of traders and a lot of analysts, as the 200-day average is usually one of those historical marks that the news agencies grab onto that there could be a bear market in place. We're not sure exactly what's going to happen here because the S&P 500 is actually very important to the economy itself. It's more like the Dow, and it's from the standpoint of how people value it. To give an idea of the weakness in the S&P 500, we actually put a volume line up. In order to get the volume, we actually used 1,440 minute bars. So this is why it looks a little weak on the actual bars themselves. But we want to note that the first, we actually have what is called a Belkiot volume oscillator. It's a proprietary indicator. We first started to notice the divergence when price passed over the 1503 historical mark. And you'll note, and the peak of our oscillator happened several bars afterwards as price started to fail slightly and then picked back up. It appears that the first divergence mark was right around here, where you'll notice that the volume's actually lower, but the price is actually higher. And of course, as volumes drop in precipitously, it's still making higher highs. Till finally, we find ourselves in December to January this year, where volume actually was going slightly higher, but of course, price was much larger than it was when it first reached this first divergence in March and April of 2012. Switching to a weekly view, the indicator itself shows that there's the outside envelopes, and on the inside, this is actually a trade channel where it showed a long trade happening for an extended period of time. To note, the price of this past bar closed below the dynamically built trade line. It doesn't mean anything at this moment because we're still in the middle of the week. But if price was actually to close at the end of the week below this, this would signal that a new trend is in place for a short. Now, of course, many can argue that you could see this much sooner, but we're looking more from a bigger picture. You know, is this the beginning of a bear market? Now, many people have indicators, and of course, indicators change, and you really don't know when they're going to change. So we built a mathematical failure on one of our indicators showing what it would take in order for there to be a crossover. This actually occurred at the beginning of this bar, where you can see this dotted blue line, cyan line. It's actually showing that a new trend will be in place regardless of what we do. So following next week, a new line will be drawing off the weekly, showing a short will be in place. We imagine that it would at least be 2 or 3 bars or 2 or 3 weeks before this would reverse around. Doesn't mean it would actually go short for an extended period, but the power of the downward movement has its own gravity before it reverses. And that's the end of this analysis. Thank you very much for visiting Belkiot.com.